Hello, and welcome to this video introducing the topic of valuation. To value a business, you first need to understand the business. You need to understand the accounting information the business presents, and then you need to think about what's likely to occur in the future. That is, we have to forecast future business operations. Once we've gone through those three steps, we can then get to the topic of how to actually value a company. That's what we're going to talk about today. So the theory of valuation is relatively straightforward. It revolves around calculating the present value of future cash flows. So if you've never done these kind of calculations before, you'll have net present value calculations. And here's a formula that we would use. To calculate the present value of a cash flow, we'd say it's equal to the cash flow divided by 1 plus the cost of capital to the power of the number of time periods in the future that cash flow is going to occur. So if we have multiple cash flows occurring year after year, we can apply this formula to each cash flow for each year that we're going to have and calculate what's called a net present value. We're present valuing all of those future cash flows. And that's the basics of the mathematics behind valuing any kind of asset. So valuing a bond is relatively easy by applying this net present value formula. When you're valuing a bond, that is when a company has lent money, they issue bonds, then it's relatively straightforward to value because the future cash flows, that is the coupon payments, the interest, and the principal repayments, paying back the actual amount of the loan, are contractual. So that means the timing is known, the number of payments that will be made is well known, and the interest rate, the cost of debt capital, is contracted, so that's going to be known. So when we apply this formula, these present value formulas, the cash flows are known, the times are known, and the interest rate is known. So it makes the valuation of a bond relatively straightforward because we know a lot of the inputs into the formula. However, there are still some complexities, and the risk of bankruptcy for a firm will change throughout the time, so that will change the risk level of a bond as well, so that will lead to some changes in the pricing of the bond. However, what we want to do is we want to learn how to value a company. And valuing a company is more difficult than valuing a bond because some of those characteristics that bonds had that made it easy to value are not present for a company. So let's think about the cash flows of a company. The future cash flows are dividends. So if I'm an investor in a company, the cash flows I'll get from owning shares in that company are the dividends that the company pays to me. And dividend payments are variable. I don't know how often I'll get paid a dividend. I might get paid 1 dividend a year, 2 dividends a year, or maybe 0. So the number of dividends I receive is unknown. The timing is unknown. I don't know if I'll receive a dividend tomorrow or next week. The company gets to choose. And finally, the amount of the dividend is also unknown. It will vary year to year, company to company. There's no fixed dividend policy that companies have to follow. That's because the board of directors for each company get to make up their own dividend payment policy. And they'll choose to pay dividends when it best suits the company, when they've got spare free cash flow, when it's consistent with their strategy, they don't need that cash to expand operations. Okay, so dividends, the cash flow that an equity holder receives, are variable. The cost of equity capital, that is, in our net present value formula, the interest rate or the cost of capital component R, that's also much harder to estimate than debt contracting. So we're going to learn about how to estimate the cost of capital for equity, but even our best estimations are very inaccurate. So coming up with that part of the formula is difficult. Similar to valuing a bond, the risk of bankruptcy changes throughout the life of a company, so that also creates some uncertainty for us. So overall, valuing a company, when we think about these present value formulas, each of the inputs into the formula is actually pretty difficult to estimate in practice. So the maths is relatively simple, but getting the inputs into the formula requires us to make a lot of estimations about what we think is going to happen in the future. And that's where valuation can be either very difficult or very interesting because we have to come up with our own inputs into these formulas. We have to think about the world and how we expect it to play out in the future. So the valuation theory was relatively straightforward. We're going to apply the net present value concept. However, there's in practice a lot of different approaches we can use to value a company. And I'm going to teach you about 5 different approaches on how to value a company. The first one is going to be price multiples, and price multiples are by far the simplest methodology. In fact, we don't even use the net present value formula in the price multiples approach. Then I'm going to teach you how to value a company based on their dividends, and that would be called the dividend discount model. We're going to value a company based on their abnormal earnings or their residual income. That is any earnings they're generating above their cost of capital. We're going to look at abnormal operating earnings Remember, we've broken earnings up into the financing and operating components when we reformatted. So here we'll value a company based on their operating earnings. And finally, we can do a discounted free cash flow model as well. So I'm going to go through these 5 valuation approaches with you, talk about the advantages and disadvantages of each of these models and how you can actually apply them to value a company, a publicly traded company, and figure out a stock price for these firms.